Alright, welcome back everybody, and today we're gonna learn more on types of trend reversal patterns, right? Another type of reversal patterns that we need to know is what we call a head and shoulders pattern. Okay, I'm gonna draw these patterns with their variations so that people won't get confused when we are opening them on the actual charts. Okay, so now the first one that I'm going to present to you is a normal head and shoulders pattern. It looks like this. It looks like this. This is the normal head and shoulders pattern, right? The second one could look like this. Second one could look like this. Okay. Bear with me, guys. Bear with me. Yes, sir. If you want to learn more, it's good. So, the second one is like this. Okay? So, these are the variations. And then, the other one that I don't like that much. Yeah. When I'm selling, I don't like the one which looks like this. Let me show you. Let me show you. Okay, so I don't like this one. Usually when I'm selling, I'll tell you why I don't like this one. But pretty much when you are trading a trend reversal move, when you're trying to catch where the move ends of the bullish move and try to catch the last tip of the bullish move so that you can just trade where the market start to make some new moves of a bearish move, you have to locate these type of setups, right? So we call these ones head and shoulders pattern. Why are they called head and shoulders pattern? It's because, as you can see, this previous high is not higher than this one, and this one is not higher than this one. So this one is the head, as you can see. Okay, and the reason why these highs, they're supposed to be like this is because you can never raise your shoulders above your head. So that's what it is, guys. So this is what you want to look out for when you want to trade trend reversals, right? So how do I represent them when I see something like this? Okay, the market, as you can see, it was making some higher highs, okay, and then some high lows, high lows, high lows, high lows. Okay, now the market would simply do something like this when it's tired. Okay, something like this when it's tired. So what do price action analysts do? They study the previous data to anticipate the new data, and then they see something that they always see, or that they always use to actually anticipate that the market is about to go down. As you can see, we now know in our heads that we have to look out for these setups, right, which are head and shoulders pattern, right? So what we simply do, we use this thing, right? So what is a neckline is something like this. Okay, these two tips, unlike M setup, right? Remember, on M setup there was just one pivotal point of a neckline. A neckline, it just let me just show you. All right, okay, this is on a previous video. So this is an M setup, right? This is a neckline of an M setup, right? So this is a neckline of what? Of a head and shoulders pattern. Okay, it's got like this double touch. What's going on? It's got this double touch, right? And then on that one, the neckline would be something like this. Okay, and then on this one would be something like this. Okay, fine. As you can see, I like to trade this type of head and shoulders and this one when I'm trying to catch this selling move. I don't like to use this type of head and shoulders, okay, which are like this, okay, which are like this, okay. Your neckline, make sure it's looking like this or straight like this, not like this when you are selling, okay. So with that being said, this is the setup that you need to look out for. How do you trade this setup? Again, we have two entry points, right? Whenever we see a strong breach, strong bearish candle breach, we enter our sells, we put our stop loss right about there, and we anticipate that the market is gonna move and start to make some new some new trends, okay, some new trends like so, like so, like so, okay. Pretty much that's it, okay. What's the other entry point? Okay, so the other entry point that we can do is that when the market comes again and does this breach and comes back to the zone of our neckline and retest, we call it a retest because the market breach and retest, the market moves in zigzag. So when the market goes down and come with a zigzag, and then we enter right about there, our stop loss right above there, and we hop onto the trades and we sell. We are trying to catch the bigger moves of the impulsive move, right? So we will be safe in that kind of sense, okay. So because we're trying to catch this big move, even if it retraces, then we can now even enter more trades, okay. Now it makes sense because I'm combining the lesson 1, 2, I think, with this more advanced one, how to like scale and make your trades more. Right about there, if you see something like this, remember on our previous videos we put a resistance line or a resistance zone, and then we make sure that this retracement doesn't breach this zone but just fails again, and then we enter more position. So right about now we've got other entry points again. We put our stop loss right about there, we anticipate this impulsive move, we measure it by seeing how the market has been doing this, and then we can even easily target this point. So for those who don't know this lesson of just go to our previous videos, you will find it, okay. So, and for those previous entry points that you would have made, okay, upon realizing these setups, you can now move your stop loss to your current stop loss, and you have got other setups that you have taken again, other trades that you have taken again to catch this move. The market does like this, you again put what, your resistance. As you can see, the market doesn't do what it wants, okay. The market doesn't do what we want, it does what it wants. So in this sense, we wouldn't have entered again, but we would have just waited until this level is breached, okay. We would have waited until this level is breached, okay. Then we move our stop losses just below this high, right, just below this high. So right about there we'll be having 2 entry points from there protecting all this move, okay. All this move would be our profits, right? All this move would be our profits, right? So this is the good thing about trading the trend reversal, because we're trying to catch the whole move going down. It can go down up until it goes to hell. I'm just joking, but hey, that's what it is, guys. So now, how do you tell that the market is about to move up or is about to creates a new trend going up? The market can do this, guys. It can come up all the way and do this and negates it going all the way down. By just doing this, it has shown us that it's about to move all the way up. It has disregarded this previous lower high. So this signifies that the market is about to make a new trend. So in this sense, since our stop loss would be there, they'll be taken out and would be and we would have walked away with this type of profits. Okay, and if our stop loss is right about there, and we catch this move, as I was saying, this is how I catch those 1:10, 1:15, 1:20 type of trades. Okay, this is the only way you can trade price action with 1:10, 1:20 type of trades, by understanding price action, by understanding previous data, understanding how the market moves. Okay, so in this scenario, you would have been taken out. Simply as that. You would have been taken out. Everybody's happy. The market starts to move again, in its original state. So pretty much that's it, guys. That's what the market does. That's what the market do. Okay, so catch me in another video where I'll be showing you some other types of trend reversal patterns. Okay.